Okay. All right. Okay, I guess we'll get started. My name is Rockiell Woods, and I'm with the National Center for Appropriate Technology. And I am from Jackson, Mississippi. Something about our office here in Jackson, we cover 5 states, which are Mississippi, Louisiana, Alabama, Georgia, and Florida. However, we work in collaboration with all sites across the United States, all states across the U.S. This grant was written specifically for the South, and it was designed to talk to a lot of farmers about insuring their farm and protecting their farms. So we want to talk about different things about different types of crop insurance to help you insure your farm. And we have Jeff Schahczenski, who is at our home office in Butte, Montana, and I'll allow him to introduce himself in his own way. And he's going to come to you today to talk to you about protecting the whole farm in the South. And he's going to tell how it just got better. So I'm going to allow Jeff to do that. A few housekeeping things. If you have any questions or anything, please feel free to put them in the chat, and we'll get those questions to Jeff. We'll get them answered. Right now, I'm having some small technical difficulties. My lights went out literally about 40 minutes before this meeting got started. So I'm going to log out as the host and come back in as a participant so that my staff, who would be Asia Tillman and Liz Broussard-Red, could assist you with anything. Right now with my internet, I don't want to run the risk of losing everything and this recording or anything like that, or any good notes by me being the host. As you know, here in Mississippi, we've been hit with a lot. I'm sure across the U.S., everybody's been hit with this polar index of snow. So, and this is something we're not accustomed to. But I'm glad everybody took the chance. I had the opportunity to get on. So without further ado, I'll let Jeff come on and talk about how the South just got protected the whole farm just got protected and the South just got better. All right, Jeff, take it away.
All right, hello. First of all, everyone hear me? Am I good? Anybody's problem, I guess they can work that out. My name's Jeff Schahczenski. I'm an agricultural and natural resource economist with the National Center of Appropriate Technology. I've been working with crop insurance for almost 17 years. I can't hardly believe that. Now, Rock said the South just got better. I don't know. You guys just had some pretty miserable things happen. So I don't know how better this is going to make it. In fact, there's often a kind of a morbid joke in crop insurance is that the only time people like insurance is when their house burns down, which is not the best time to think about it. But right now, I think crop insurance is suddenly going to be more important to folks who have just been through some serious problems. And I know that your season starts a lot earlier than ours. I'm in Butte, Montana. That's a really far north. And I know today that Jackson, Mississippi and Butte, Montana are only 11 degrees in difference right now, which is like the most unusual thing for this time of year to ever happen. Fayetteville is another office we have. It's like only 1 degree difference. It's never happened. So these are interesting times. I'm going to talk about crop insurance, and I'll start to use jargon, and you type in the chat and have them correct if I need to define or here's some basic things that you'll hear me say. Liability. Crop insurance and other insurance are somewhat the same in terms of their jargon, but liability, it's the value of what is insured. And in crop insurance, it's never 100%. You can get up to some special programs, get up to close to 90% insurance, but you can't get 100% coverage. Indemnity, that's often a word that's not heard as much. It's the value of the payout for your insurable loss. It's basically what you get paid after they do the adjustment. You know, it's very similar to health and other insurance, car insurance. Premium, the cost of insuring. In crop insurance, that's both paid for by the farmer and paid by us taxpayer dollars. So it's government subsidized. And again, let me know when I use any insurance. So the farmers need, ranchers need crop insurance. Well, after the last couple of days, I think the answer to that's kind of pretty easy. But the first thing I want to say before I get into crop insurance, I'm going to start with some general stuff, is that crop insurance is only one way to mitigate risk. And my understanding of a lot of farms, and I'm sure it's true in the South too, is that risk can be mitigated not only by buying crop insurance, it can be mitigated by the way you farm, maybe the diversity of crops you have, more carefully picking the crops for the environment you're in, although that might be harder these days. But anyway, the point is that there are other ways to lessen your risk besides contracting. There's other ways to mitigate risk besides crop insurance. So it's only one tool. And you might not need to buy insurance to reduce risk. In many cases, we've been finding through research and other work I've been doing that the more different products a farm grows, they sometimes can diversify the risk simply by their crop and livestock diversity. And that might be good enough. So, you know, I'm not here to sell crop insurance, even though sometimes it might sound that way. First of all, how does this crop insurance system work? Here's a basic diagram. It's interesting that crop insurance program in the United States is it's a both private and a public entity, which is a bit weird, but and I sometimes characterize it kind of as a nonprofit program. But you have actual private insurance companies. The term they use is accredited insurance providers. There's only 14 major companies that are under contract with the US government to sell products that are federally subsidized. Now they can sell private policies too, like hail insurance is sometimes sold privately, and these companies can sell those. But if they're going to sell federally subsidized programs, they are part of the program and they're one of those 14. Then there are many independent agents who will often sell for these companies. And basically the federal crop insurance corporation is kind of the entity, the bank where the money goes back and forth. It's kind of the overseer of the whole federal program, but it's basically operated by the risk management agency, and they kind of set the terms and the guidelines for the policies, and they basically shuffle money back and forth. So in a sense, the government is hiring private companies to service the products to you, the farmer. They get the benefit of, they get some pay for that. They get paid for that, and they also get to share in any revenue generated. It's called underwriting. Basically is anything that they didn't have to pay out. They can share that. And so it's kind of a lucrative thing for the insurance companies. But is crop insurance a safety net for all farmers? This is an interesting thing that this is real recent data. This is 2020, but you can see that 4 crops represent about 65% of the total premiums paid out. So it's really a lot. While there's many crop insurance products and they cover many crops, a lot of the subsidies, a lot of the premiums go to the major commodity crops, and you can see that the tomatoes is a very small part of that subsidy. That's in billions of dollars, by the way. Another thing is that there are really 2 major kinds of risks: yield risk or revenue risk. Now, yield is the thing that we often call as multi-peril. It's the things like what just happened. When snow comes at the wrong time or a freeze comes at the wrong, that's a peril. And that usually affects the potential yield of the crop you're growing. So that's yield protection. That's only the thing they protect. Revenue, however, is basically yield times price. As you all know as farmers, that when you plant your crop, you might think you're going to get a certain price for your product, but at the end of the year, that price might be different. Therefore, you're exposed to what they call price risk. Well, most of the crop insurance these days is revenue protection, at least for the major commodity crops and for so many other single crops. They do have revenue protection, it's called. And as you can see that, again, revenue protection is the way that a lot of farms have gone. Because, why? Because they get the advantage of shielding themselves from the risk of a price change and the risk of a multi-peril. Whereas if they only take yield, then what happens is they basically only cover one risk. So if you can buy it and it's affordable, having revenue protection usually is more advantageous, and hence you see its use in expanding. And those acronyms are revenue protection, yield protection is YP, and actual production history is another form of yield insurance. But those are the principal two that make up. And we're going to talk about a special kind later. Does crop insurance subsidy impact what farmers grow? The unit of analysis in crop insurance is the county. You can be in one county and have a crop insurance program for a certain crop, and it might not be in the next county right next door to you. This is a map of all the counties where you can buy corn yield or revenue policies in the United States. And as you can see, even Montana, which I sometimes wonder why we grow corn here, but we do, you can get protection for corn in a lot of counties in the United States. But if you shift to fresh market tomatoes, you can see the map starts to get pretty empty. These are the only counties in which you can buy crop insurance for fresh market tomatoes. And it's kind of interesting to look at these maps because it really tells you why are those counties there, the only ones where there's crop insurance for fresh market tomatoes. And I would argue because there probably is a lot of production there, and it's close to probably a processing facility, and where the bulk of major tomato production is ongoing. And that's kind of interesting, particularly for fresh market. So here, me in Montana, I can't buy insurance for just my tomato growing, even though I can grow tomatoes, believe it or not, in Montana. Now, I'm going to talk about a program called Whole Farm Revenue Protection. It's a very unique program. It's really been around for a very long time, 18 years actually, but in the 2014 Farm Bill, it became available in every single county in the United States, including Alaska and Hawaii, which aren't on this map, unfortunately. But as you can see, it's in every single county. So whole farm revenue, which I'll talk about a bit later, is basically covering your historical revenue or your income. It's kind of income insurance. It's not insuring any specific crop, but rather the potential of your farm to produce revenue is protected. It'll become more clear, I think, later. And this is very unique. It's very different than most all other policies. And unlike any other policy, it's available everywhere. So through Whole Farm, I can insure my tomatoes in Montana. So why whole farm revenue protection? First, is a major purpose of insuring to assist farmers to stay in business and keep farming? I would say yes. And so ensuring revenue is just as, in some senses, is as important. The whole farm's capacity to produce revenue, that's bottom line is what keeps your farm going. So if you can insure part of that, kind of insure your revenue, then you can keep farming. So in some ways, Whole Farm does that quite well. It's not specific to any specific crop, but to the whole farm. Farmers decide what to grow, and the taxpayers help them protect revenue. In other words, with Whole Farm, it's not you choose over time, obviously you do, the things you want to grow that will maximize your profit. And if you grow those, this policy in particular will look at that revenue potential that your farm is doing those crops, and it will, based on your historic revenue, will insure up to 85% of your revenue. So it's not saying you choose what you want to grow to maximize revenue and we'll protect your revenue. We're not going to protect any specific crop. Therefore, we're not picking and choosing winners with taxpayer dollars, which are subsidizing this. Covers almost any product in the United States. there's a few exclusions like show dogs and things. As you'll see later, the types of crops under whole farm and livestock products included is extensive. It incentivizes crop and livestock integration. In other words, it, again, because it's based on revenue, not on what you grow. If you grow eggs or you grow some cows and you grow crops as well, that's all part of your historic revenue. Therefore, all of what you can insure in the future. So it doesn't have limitations in terms of livestock products versus crop products, which is very unique. And revenue is spread across all products grown. So in other words, you have all the things together and that revenue is generating. So sometimes one crop will do better than the other crop, one livestock product will do better than the other, and those are kind of balanced out. And therefore, in a sense, it also becomes cheaper because the risk is greater the more you're diverse. And it's kind of a package deal. The premiums generally are less than buying individual policies if they're available, because as you saw in the map, fresh market tomatoes wasn't even available in most counties in the United States. So therefore, whole farm is the only alternative in a sense that you can use for some crops that are, and again, if you could buy individual products, it's generally more expensive than buying this kind of package deal for the whole farm. I'm using Mississippi today as an example. And this is the use of whole farm revenue in Mississippi. As whole farm revenue, it really started in 2015, but it was an earlier program called the Justice Grow Revenue Light, which was many years before. But anyway, since 2015, you can see right away when it first kind of came out as whole farm and was available everywhere, Mississippi didn't have any interest in it. And then in 2016, it built, and now we're up to 92 policies. Now, 92 policies isn't great, and there are other states that use this product way more than Mississippi, and I'd say many southern states, which is why we're doing this education, because I think it might be a viable alternative for folks in the South that haven't really explored it. The reason that, and what you can see is the liabilities, again, that's the value of coverage is in the millions of dollars. So it's gone from 0 to $110 million worth of crops have been insured in 2020. And from 0 to 8 million in premiums paid, and that was subsidized to the tune of 6.4. So the farmer only paid the difference, and so the farmer premium is 1.6 premiums, and these are the payouts. Remember, indemnity is the payouts. So it's the millions of dollars that were paid out. That reason it's in red is because it takes time to process, and so that number is probably not accurate. The liabilities and premium subsidies are, but the indemnities are probably still being paid, so that it's probably going to be higher in the future. This is some data from research we did over a 5-year project, and it shows like different kinds of products from, I didn't get up to date here, but you can see there's a wide range. Again, in $52 billion in total liabilities were covered during this whole period. And you can see that a lot of traditional crops, this can be used by soybean and corn farmers too. It isn't relegated to small crops, little crops. You can see all the different kinds of crops that have been in the past have been utilized. And this is by the value of those. There are some limitations. The one thing is that if you're not a beginning farmer, you have to be in your 6th year of farming. And if you're in a beginning farmer, which is defined for this program only, actually, as farming 10 years or less, then you only need 4 years of record. So you can't be a very, very beginning farmer and take advantage of this program. You have to develop a kind of a history of revenue over your farm. As a beginning farmer, you have to have at least, you have to be in that 4th year. And then you have to have tax records, which we'll get to show that. So it isn't for the absolute beginning farmer. That's one of its disadvantages. There are limitations in the maximum amount for livestock and nurseries. So if you have over $2 million worth of revenue from animals and products, you can't cover past 2 million, and greenhouse is similar. There's also an overall maximum of $8.5 million in revenue, but I'll show you how that works in a bit. The commodity count becomes important. And the commodity count is just the number of products that are grown. And there has to be a minimum. In other words, if you had 5 things that made up 95% of your revenue, and you only have 5% in another product, that 5% one would likely not count. It has to meet a certain minimum criteria of actually contributing towards the revenue of the farm before it's counted. And commodity count is important because certain advantages come from the more diverse you have, and the level of coverage is dependent on how many commodities you're growing in the year you want to be insured. And so if you have a bunch of little things that really represent a small amount of your revenue, you can combine those together. And that's kind of a unique thing of this too, to count as another commodity, but it's really a collection of several others. So this is the coverage level limit. And it seems kind of weird, but if you have 3 commodities that count, that are contributing significantly toward the fund or more, you can get coverage up to 85% of your historic revenue, approved revenue. And that means that you could get up to $10 million. You could have $10 million worth of revenue, in your year of expected thing that you could actually cover, but not above that. However, if you're willing to have less, this actually can be used for farms that only grow 1 commodity. However, that 1 commodity can't be a commodity covered by another product. So that would be like, say you were only having fresh market tomatoes, you could cover it under whole farm, and there wasn't any other policy available in your county. You could cover up to 75% of that 1 commodity, and so even with 1 commodity at a 50%, you can have up to $17 million in coverage. I put hemp in here because this is kind of new. Hemp is new, as you know. Industrial hemp has now been approved in many states to grow, and there's protection. Whole farm revenue is one of the major ways in which you can insure hemp. So if you're growing hemp with a bunch of other crops, you can insure it with whole farm revenue. Now I know in Mississippi they don't have this program available yet. They also have individual yield insurance for hemp in certain counties, in certain states. And those are the states, and I underlined the ones in the South that do have a hemp program for individual hemp, but you can always do it in all of these states as well as whole farm, but not in Mississippi. Mississippi is, there's some rules about states wanting to allow the hemp program to exist in their state. There's also a program that you might be familiar with called non-insured crop disaster assistance, which is another program that we're not going to discuss here, but I have some good publications. So some of you might be familiar with that. And hemp can also be insured under that. Some practical limitations. You really have to have, it's kind of true for all crop insurance though, because you have to monitor your production history and other things. But probably the paperwork burden of whole farm is higher. It requires farmers to provide yield and revenue data per crop, per product. Some might need to start, you might be needed to start to collecting this data if you're going to apply. And it's less onerous if you have a contract, because the contract really defines what you're growing. If you sell wholesale, that's usually makes it easier. And if your number of crops that you're going to insure is somewhere between 3 and 7, once you get up to 10, 11, 12, 13 different crops, it becomes kind of onerous to actually show and demonstrate what you need to do for whole farm, what your production is going to be and your expected price is going to be for each crop. And that can be kind of, depending on how well you take records, that can be a burden. So I'm going to do a quick example here from Mississippi in Hinds County, which is the county where Jackson is. I just picked that arbitrarily. Well, no, I didn't pick that because I thought that was, and Rock gave me some good data that I could use to give an example that's somewhat realistic. However, this is just an example. This can't be easily applied. What's really hard about whole farm revenue, it really depends on the history of what you've grown in your particular location, in your particular county. So it's no simple, easy way to just say, will it work for one or the other? So this is just an example, and a somewhat simplified example to make it easier to understand. The premium cost and indemnity payments may differ considerably from even if they were the same crops. If it was in a different county and a different state, it might be a different premium. It depends where and what you're growing really determines that premium and likely what your coverage will be. And again, an agent can really help you do all the details that I'm talking. There is a great tool and that you can log on to. That's the link to it that will find, it's called the crop insurance locator, and it will actually show you the nearest crop insurance agent that sells federal programs like Whole Farm Revenue and others nearest you. It's a pretty good tool. It's not perfect, but it's a pretty good tool. It's a lot better than it used to be. Again, what you need for Whole Farm is you're going to have to have your Schedule F or an equivalent or tax equivalent. So this is another thing that might make this a hard policy to use. The way they determine your historical revenue is based on your tax records. Again, I'm going to say that it's based on your tax records, and Schedule F is the typical form in which people pay their taxes when they're farming. It's not the only one, and the agent can convert any other form to an equivalent of that so they can buy this policy, work those details out. But, of course, you have to have some basis on which to set the premium. So they're using tax forms. And I know I'm not going to get into whether people report all their income from farming on their tax forms, but if you do, and it's pretty accurate, then obviously it will cover. If it isn't, that might be an issue. But I'm not going there. That's your business. But that is the form. You'll have to provide those. And this gives you some, then you're going to have to determine what your expected revenue will be in the year that you want to insure your crops and livestock products. Again, and it can be based on your history or other sources. If you have an organic system plan, that often really helps to apply for this program because you have a lot of that information already available. The first thing they're going to do is look at your historic approved revenue and expenses. And again, these are based on tax forms, and they can ask for other documents, which also can sales records if they don't quite think that your tax records are accurate. Now, that's a very controversial issue, and it has to be worked out with your crop insurance agent. But they are going to figure out what your revenue was for your 5 previous years. If you're a regular farmer, you're not a beginning farmer, or at least those 3 years before that you are if you're in your 4th year as a beginning farmer. So, but that approved also means that they're going to only look at revenue generated by the farm and not by other things that you might do, like hire yourself or rent out things, or it's not going to give revenue. Say you grow raspberries and you're going to make raspberry jam out of it, and you sell the raspberry jam. Well, the revenue that comes from the jam part of the operation is not going to be included as revenue insurable. It's only the raspberries themselves to the point kind of where they leave that field, the value at that point. So they're only going to cover production value, not added value products. This is just an example of a smallish farm, I guess, 5-acre farm. That's not small for vegetables, but anyway, these are data that Rock gave me. I don't know how accurate they are, but let's just say that this farm averaged in these last 5 years, $21,600. You can see that this farm is fairly volatile, but you can see that it's moving upward. And it seems to be moving to generate closer towards the 25, 20, it's moving in a direction where 30,000 seems to be a pretty good gross revenue for this farm. Let's say this is the year, what he expects revenue to be in the year of an insurance. And these are just peas, tomatoes, watermelon, squash. They even have collard greens separate as collard greens under Whole Farm. It's pretty amazing the different kinds of crops they include under Whole Farm. And then I just put eggs in there to show that livestock products are also insurable. So this year, the farm thinks it's going to make 30,000, which is not too unrealistic considering the last 2 years, as you saw, they made close to 30, 31,000, right? And they got 5 acres going there. And so the historical revenue average was 21,600. Expected is 30,000 in 2020. Now, here is a big point that's really critical. the insurance premium and the coverage is going to be dependent on the lower of these two numbers. So in this case, you're really only going to get insured for the potential of the farm, and that potential is surmised through this program to be 21,600, not the 30,000. So right there, it's a bit disappointing, right? You say, oh, shoot, I think I'm gonna make 30 and I can only cover 21,600. Well, the reason that's partly done is because they're looking at what you on average are expected to produce. Now we've made some improvement. That's why it's becoming better. And I'll show those later about this problem. But it's a point to note here that if you have a volatile historical revenue, your revenue is pretty volatile, then your average is likely to be fairly lower than perhaps you're expected. And also, as you might note, that over time, generally people get better at farming. Not always, but they tend to get better. So they tend to have less volatile as they become more experienced. And therefore, that average is kind of pulling them down and not really giving the coverage, because now they can really generate 30,000 or maybe even 40,000 because they're getting good at it. But it doesn't work that easy. Yeah, is there time to break for you? Or go
well, no, I have a question. I had a question, or you want to save it for the end?
Go ahead. Let's have a question right now.
Okay, let's just say I have a 5-year historical average on my farm of making that $30,000. Will they still go with that historical average in revenue if I had to make a claim?
If that example was that your historical average was 30 and your expected in the year of insurance was 30.
Oh, expect, okay.
Then it would be 30, because it's the lower of the two in this case are the same. So,
okay.
So that's the important point. That's actually a great question, because the closer your historical average is to your expected, in a sense, the better your coverage, because you're going to actually cover it for what you really think is going to be the revenue that you can generate. But if you have a volatile history and you have lots of ups and downs, your average is a lot lower than your current year, then it already starts to say that your coverage is not likely going to be covering what you think you can produce. But their argument from the other side is to say, well, yeah, well, maybe you just had a good year, or you expect him to have a good year. But looking at your history, it doesn't look like you can actually hit 30,000, right? So that's why they do that. But on this slide right here, I'm going to show you what a number of my friends and I actually worked and changed federal policy to make this a little bit better for that situation where one has a volatile history. And this just came out last year. So in this coming year, it will be true too. But this is very new, and that's why it's gotten better, because we've worked out we've fudged this a little bit. And it's a little complicated to explain, but this slide will hopefully explain it. Let's say this farm went ahead and he insured, and they had a 50% loss of revenue at the end. At the end of the year, for what all combinations of reasons, their revenue coming in was $15,000 rather than $30,000. So they want to claim. They want to make a claim that they've lost $15,000 from their expected. So their average was $21,600, expected was 30. The loss puts them at 50,000. Now, we're just going to pretend that last year they used whole farm revenue. That becomes important because this is an option now. Last year, their approved revenue was 23,000. This year it's 30. Anyway, that's just bear with me. So there's 3 methods. So your insurance agent has to run 3 scenarios for your farm rather than just one. One way to do it is they take what they call a 60% substitution. So you got those 5 years and you take the average, and then any year in your 5 years that is, let me get this right, that is below 60% of your average, you put the 60% number in there. What does that do? That means your historic revenue rises up to basically to 25,183 rather than the 21,600. So that's one method to look at. The other method you can do is you can exclude your worst year. If you take the worst year out of that scenario I showed you, then the liability coverage goes to 25,500. Again, that's at 85% coverage, because that's the highest coverage you can get. And then the last one is to take, it's crazy, I know, but they take 90% of your previous whole farm revenue number, which is 23%, was 23,000, that 90% is 22,600. So you can see that you have to run all three scenarios. The farmer premiums for these are different. The indemnity payments, provided this was the loss, that's your payout, is different. If you take the net less the cost of your premium, these are the different 8,000, these are the different things that you, the indemnity you would get paid. You know, we're just saying that, you know, it costs money to buy it. So that's your net premium. So the farmer, the final farm revenue, when they get paid for their indemnity, is going to be any one of these three numbers. And of course, what I picked out in yellow is the one that seems the best, because that's the one where your farm revenue is the most, and you're benefiting most. So you run through these scenarios ahead of time, and I mean at the end, and then you basically, you basically can choose one of the options for coverage. And so basically choosing the exclusionary year is going to be, would have been the best choice in this case. And so you have those, now you have those options. So they have to kind of run these indemnity payments and options here. You have to work with your crop insurance to run through these more complicated things. But what you see, our attempt in changing this was to try to move that volatile history closer to your expected, so they would be more functional and more valuable for the farmer to use. The other thing that's very unique about this policy is the more products you grow, the lower your premium. And it's not a simple conversion. It's just not like if you grow 5, you get this percentage discount. If you grow 6, you get this percentage discount. It doesn't quite work that way. Of course, it's always complicated. But in this particular case, if I were to move from 6 to only 2 products and using the same historic expected revenue, I'm sorry, that should be 3 products. I made a mistake there. Let's say you just grew watermelon, peas, and squash instead of the other crops and your eggs. Then what would happen is that your premium raises compared to the 6 products. Because why? Because you have less eggs in the basket. If you have fewer things you're growing, the risk becomes greater because the revenue isn't diversified. And the risk isn't spread across all 6 products rather than 3 products. So there's a benefit that is given to you. And that's what I really like about whole farm revenue is that it encourages crop diversity, which is in livestock, crop and livestock diversity. And it encourages it because it gives you a lower premium for doing so. And therefore it costs taxpayers less because you have to subsidize less. So it's good for the taxpayer. It's good for it encourages diversity, which I think is good for sustainability. And it's the only program that does such a thing, any policy that does such a thing. But this discount, this 11% could be very different in different counties depending on the crops you grow. So it's not simple to say it's always going to be 11% cheaper. And again, I'm not selling this. So again, is it worth the time and money to do this? You've got to collect those forms. You've got to have that retail price data. You've got to look at what your premium cost is going to be. Do you see crop insurance as an investment in your farm? Or do you see it as a yearly operational cost or a cost you can't afford? Do you want simpler catastrophic, or do you want price or yield? Can you possibly insure one of your crops with another policy? There are other ways of predicting, and as I said, there are other ways. So whole farm is not necessarily ideal. You really have to run it for your farm. And again, determining the expected price can be sometimes hard. Again, you have to validate what your prices are for those products. Say you're growing a new product. If you haven't historically grown, you have to defend that you can actually get that price and that yield. If you grew it before, it's kind of easier to do. If you have a contract, it's easier to do. But that has to be determined. You have to determine the expected yields. Again, it has to be consistent based on usually your historical yields. County averages can sometimes substitute if you haven't grown it before. And there's details that your agents can work out on the issue. In 2021, this coming crop year, they have this new thing called the combined direct marketing means option. And all that says is that to the extent you grow things that are direct marketed, this is the definition, and that is sold directly to the consumer, not wholesale or through some other party or through a restaurant or something like that. That doesn't count. But any crops that you grow that are direct or livestock that are direct marketed to consumer can be combined into one code, into one product, one commodity. And that is supposedly to help with paperwork, but I'm not convinced this is true. And it hasn't been really run yet. So, but talk to your agent again about this option, because it might make the farm that has a lot of different things that are direct marketed, it might make whole farm revenue a little bit more attractive to them. There's a deadline in Mississippi. You can still buy it. Not much time left, but the deadline for buying this insurance is on the 28th of February, end of this month. Take homes. Whole farm has improved, but it needs further improvement. We've been working to make it actually work better for farms. But it could be a way to lower public cost and incentivizes sustainable diversity. And we have some very good recommendations based on a project we did. If you're interested in more details, whole farm may be useful when there's no alternative. Like I said, I'm here in Montana. I can grow fresh market tomatoes. I can sell fresh market tomatoes. I can't share them as fresh market tomatoes, but I can share them with whole farm revenue. And it's true of any county in the United States.
Jeff, you have a question in the chat. This is from Nina Evans.
Yes.
If you put all of your directly marketed crops into one commodity, would that lower diversity and increase your premium?
Not exactly. It wouldn't lower your diversity because you're really going to grow all those different things. You're going to be diversified. But since it's treated, let's say you grow 3 products that aren't direct marketed, and you grow a whole bunch of them that are direct marketed. So let's say you have 3, and then all the direct market counts is 4. Then your commodity count is 4, right? And so the premium would be based on the value of all those direct marketed products plus the other 3, and it would still have some diversity. It's true, you're kind of learning that discount, because if you had them individually listed out, and you can do it either way. You don't have to combine them as direct marketed products. It's just an option. But it makes the paperwork a little easier. But it's true if you went 5. But we have found that once you get over 7 products, that incentive for diversity, that lowering the premium because you're diverse, doesn't decrease any further. And really often the difference between, let's say, 4 or 7 isn't all that great. So it's kind of a trade-off. Do you want to make it simpler to take care of all those different diverse crops you use, and combined with the other ones that aren't direct marketed? It really is unique to the situation of that particular farm. So, but yeah, there's a little bit of a trade-off there. I'm almost done. So again, you really have to work on there is a lot of input that has to go in, and you got to work and find an agent who wants to sell this. A lot of agents will push people away from this program we found. They don't like it because they don't want to spend the time. It takes them a little longer. Every federal crop insurance agent, that's selling federal crop insurance programs has to provide it, but that doesn't mean they want to provide it. So you really need to work with somebody who wants to help you work this through, because it will take a little, and not many people, not all crop insurance agents are familiar with it. There are more and more of them are, but we have found that sometimes they just don't want to deal with it, and they legally can't tell you that they can't. It's just that you don't want to work with somebody who doesn't really want to help you, right? And again, it's crop insurance, federally subsidized, not private insurance though. So you have the right to ask these people to run these costs for you and to work through this program. Again, you don't really want to make someone do it, but they really do need to do it. And if you're having problems with an agent, you can, I'll give Rock the number. You can call your regional office for RMA, the risk management agency, and you can complain. You can say, this agent isn't helping me. Why aren't they helping me? They should be helping me. I'm interested in this product. Why aren't they doing it? Sometimes you have to do that if you can't get the right kind of help. And if you have problems, you should always go there too. We have all kinds of publications. These are just some. Rock can get this all to you. There's even more than this. I was talking about NAP. There's a really good publication about how to compare whole farm with that product, which is somewhat similar, but I don't think is quite as good, but that's my opinion. We have also NCAT ATTRA, and now I can finally get to any final questions.
If there are any questions, please unmute yourself and ask questions. Otherwise, we also have, before you leave, we also have a poll or an evaluation we want everybody to do for us. This is to help us. We have an evaluation that we need to get done, as well as you can ask your questions also.
Hey, Jeff, I had a question for you.
Sure.
If I was to open a farm and a restaurant that used all the vegetables from that farm to produce food, now the food is a value-added product, would I need to have two different companies, one company for the farm, and then sell that, quote unquote, sell that produce to the restaurant and then sell that?
Yeah. That's a very interesting situation. And if you really wanted to use whole farm revenue, you would have to have the business is separated, and you would have to generate those, those tax, that history. In other words, you'd have to have separate Schedule F or equivalent, because there's LLCs, there's different ways to incorporate a farm, and then it would get a bit tricky because you'd have to, if you filed the tax record, that would show that you had sales, but then you would, in a sense, you'd have to show that you actually had a value. And if you're selling a cucumber to the restaurant that's just cutting it up, you haven't value added it at the farm. When it passes the farm field, it's still the cucumber and has a value, and that's what's insured. But as soon as it's a restaurant and you chop it into a salad and you sell it more, we don't have, unfortunately, we don't have restaurant insurance like this yet. But maybe it would be nice, right? Because restaurants are probably one of the most risky businesses next to farming. But yes, they would have to be separated, because the only way they could write up a whole farm was based on a revenue history, which it would have to be based on sales, which would have to be into a tax.
Thank you, Jeff. I appreciate it.
No problem. Yeah, that value added thing, I'll just add on here, is a bit tricky, because what's really considered a value added? I mean, if you wash your eggs, did you add value to them? I don't know, but that's not really, it's kind of, they have this idea that it crosses the field, or, you can put it in a package, but if you convert it to something else and that adds to its value, like you go into the farmer's market, then they have to do this craziness of abstracting out the value that was added, because crop insurance in general has only been focused on the actual production of the crop as it leaves, not on the value that might be created somewhere in the supply chain. So because it's such an unusual product, they had to go backwards and do that, which again, that can cause, depending on how much you do that value added stuff, can make it a little more onerous to determine what your actual production revenue is, And the paperwork is the other issue. But I would argue here too, that if you're really going to be in business for a long time and you're going to get loans and all other kinds of things, you need good record keeping. And I don't think the record keeping is particularly onerous for this. One of our biggest problems with this product is that RMA and the crop insurance agents, they get so upset and paranoid that somebody is doing shenanigans or something, that they want to look at records if they don't think the tax record is right. And we just say, look, prima facie, the tax records are the best demonstration of the potential of the farm to generate a revenue, and just leave it at that, unless you have some really good reason to go further than that. Something I didn't talk about is they also track your expenses, and they want you to provide that information. It's the only crop insurance policy in the country where that's required, and we are trying to get them to eliminate that. There's no need for it. There's been no explanations as to why they need to do that. I think there's some fear of fraud. They think that you won't be spending the inputs that you need to spend to generate the crops so you can correct crop insurance. It seems like a crazy thing, but some of that is happening too. So again, the paperwork is definitely more. I think it's doable, and to the extent that you can really get good paperwork and get good records, which I think you're going to need anyway, it shouldn't be that hard.
Hi, Jeff. This is Charlene.
Yeah.
Can you hear me?
Yep.
I have a question. I think you may have answered it. I have a, or rather, in regards to the paperwork and the historical portion of it, and for the collard greens, I did collard greens, and that I donated a few years ago to a nonprofit. And so back then, my farm was in operation, I think maybe 3 years. And that was from 2010 to 2013. And then, so I started again last year. So I've got collards again, but I'm going to be planting collards and mustard, but I'm going to be planting okra later on this year. Mm-hmm. My question is but I know you said you need to be you have to have at least 4 years as a beginning farmer. Is that right?
Correct. And that's defined as being in farming 10 years, no more than 10 years, 10 years less.
Okay. All right. So, okay. But your
How long have you been farming?
I'm sorry.
How long have you been farming?
Okay. Probably all of my life, but.
I know most people say that too.
Okay. But on my own, I started back back in 2010 until 2013, and then I left.
Yeah.
I left the farm for a minute and started again on last year and year before last, but mostly last year.
Yeah.
But so that's pretty much how long I've been. But our farm is the historical farm since 1824. So
yeah,
it's a family farm, and it's been around since 1824. But we're just trying to.
I think the answer I'm getting to is no. You can't have a big period of interruption like that. They're not gonna, because they need a continuous operation. Okay. It has to be the previous. The reason it's the 4th year rather than the 3rd year, I mean, it's really funny. This is actually something I should point out, is that the way you get paid ultimately is you have to file. So you have your loss in 2021 and you file for your loss. Well, you can't determine your loss until you filed your taxes.
Exactly. That's right.
And so once you file your taxes, then you can go backwards and they can calculate. So you have to wait a bit of a time because, you might have had the loss then, but you got to wait till those taxes are filed. Mm-hmm. And the reason they have that interrupter year, why they say 4 years before, is because they never count the year immediately preceding, because they don't know what that is usually. Right? Like right now, you don't necessarily, well, I do because I did file my taxes, but some people may not have their taxes filed yet. So they don't have that as data to come up with your approved revenue. So they go back 3 more years. And so even with a farmer who's been around a long time who switches to whole farm, they always skip that leap year, that 6th year, because they only go back 5 because usually they don't have the data for that year.
Oh, okay. All right.
Why it's kind of like
I'm actually really just in my 1st year.
Yeah. So you're unfortunately for whole farm, you're in your 1st year, which means you got to establish 3 years, and then in that 4th year, you can go back and then
Okay, got it.
So it's unfortunate. That's probably one of its biggest drawbacks. Mm-hmm. That's probably why people like NAP too, because NAP doesn't have that requirement. Mm-hmm. But because
I did apply for NAP and so I've been approved for NAP, so that was good. I just want to make sure I'm considering for my bases here. Yeah. Oh, okay.
Maybe we can talk about NAP some other time, but NAP would immediately be available to you, which would not be and there would be a discount for beginning farmers. Although, yeah, and that is its advantage. That's one of its advantages, is that it truly can be for the beginning farmer. Whereas this one, you have to establish that revenue history, because it's a basis upon which they can determine how risky you are as a farmer, in a sense. And so insurance is all about risk determination, if you haven't figured that out. That's the way they make money. Now, the federal crop insurance policy doesn't have to make money. it has to break even. By law, it has to break even. It's kind of funny. It's like a nonprofit. Whereas if it was a private insurance company, they basically want to charge you more premium than they pay out. That's how they make money as an insurance company, is they charge you more than they pay out, and then they invest that more into something else and make money. Okay. Well, if this is subsidized, the way it works here is that they try to set premiums so that overall they capture the amount they pay out in losses is the same amount of money they came in. It's called the loss ratio, and it equals 1. And they, by law, the federal government has to set premiums such that on average, they take in as much as they take out. So they don't have to make a profit on farmers, but they do have to break even.
Break even, yeah. Okay, got it.
And taxpayers are paying about 64% or 63% of the cost. So they got to mine taxpayers' money.
Okay. All right. Thank you. I appreciate it.
No problem.
Okay.
Any others? Anyone on the call ever used this or heard of it before? I am very curious. One of our things with this project is we have found that in a lot of southern states, although we showed in Mississippi there's been some use, I've found a lot of policies compared to all the policies written in Mississippi. So they are using it, but I'm curious if anybody know of or heard of it before this thing that's on the call today.
So this is Aisha. I'm in South Texas, the Rio Grande Valley.
Yeah.
And we've talked about it with some of our producers at a couple workshops over the last, well, 2 years. You know, this last year has kind of been a bust. But our kind of thing is that it's hard for us to find an agent that's willing to talk about it. I know 5 or 6 agents because we used to have an RMA project. Right. But only one of them now, only the one does whole farm.
Well, when you say that, see, that's what really bugs me. When you say only one of them will do that. Well, at one level, technically, they're legally obligated to. Now, of course, they don't want to sell it. That doesn't mean they aren't really obligated to sell it. You could push this. I mean, but of course, why would you work with an agent you're pushing into selling a policy?
Right.
To you? So, I mean, whether it's legal or not for them to do it, it really amounts to the same thing. And I do think that is that we have done research. That one of the reports, a 5-year project, and we actually interviewed agents across the country about whole farm revenue. Some of them I can't even repeat what they said because they didn't say nice things about whole farm revenue. And I'm telling you, they said things that I can't repeat over the air, as they say. But yeah, other agents who said it was the best thing ever for the clientele they wanted to serve. What we've been pushing with agents and the crop insurance companies is that this is a new area of business because a lot of these smaller, diverse farms with products that aren't covered any other way could be new business for them. And if they would learn how to sell it and learn to build a clientele, that's how you make money as a crop insurance, is to build a client base and renew their policies. You make money every time you renew. So what we're trying to do is to motivate agents to see this as an opportunity for increasing business. Now they see it currently as an opportunity for maybe getting themselves in hot water because it's a little more complicated to understand it. So they don't want to go there, and they can make more money selling the policies they're already selling. Mm-hmm. But that's not legally correct. But yes, it is to come back to the bottom line here, it is a problem if these companies aren't willing to make a little effort to do what they need to do. And if they want to make it, and they could, and as you can tell, they can make it easy for you to go through the process, or they can make it hard. So if they don't want to sell it, even if they were forced to, they would just make the process hard for you and make you feel miserable, and then you never come back again.
Yeah.
So I mean, it's a catch-22, but it isn't an inherent flaw of the policy. It's kind of an inherent problem of the whole industry and the structure and the uniqueness of this policy that people are. But this is not true everywhere in the United States. There are some people using it quite well in a lot of states, and it is a significant. It's not the biggest policy in the world, sold out there, don't get me wrong, but I think has the best potential to serve more of agricultural crop insurance than any other policy out there.
Yeah, when I think about the agents that we've talked to about it or inquired with them, And now that you've said what you've said, I think that the big difference is that some agents aren't agents full time. And maybe that's why they don't want to put that much effort into it. But this one agent Adolfo, who did say it's a great product, but it's very complicated, crop insurance is his full-time gig.
Right. Yeah, there's a woman here in Montana. You wouldn't think Montana, you know, with our cows and rains and things like that. There's a woman here who won an award for selling whole farm revenue protection because she developed a whole client base. For instance, a client base that's really interesting with the whole farm is organic farming, because if you've been a historic organic farmer, then the value of the organic products are embedded in your revenue. And therefore you automatically are covering the value of those organic crops, which is not true, not technically true for individual organic products. And so there's a little wiggle room in there, but the point is that she was a young woman making a new business for herself in a rural county where there aren't much employment. And she decided that if she went gung-ho into this and tried to convince people and actually sold it, you know, promoted it, that she did well. And she won an award from the insurance industry for her expertise. So there are examples of people. The whole state of Washington, for instance, over the years has done the best job of any state in the country selling this policy, because they found the niches where the farmers that couldn't get insurance other ways could finally get insurance, and they made it easy and got them to use it. So it's you know, it's a difficult thing we're talking about. That's why we're doing these things. And well, I've been doing it for 18 years. Is that I've been trying to convince more and more folks that, you know, this is a good direction to go in, and to try to encourage the industry and to reform it, because there is some serious issues with the way the policy is structured now that we have argued should be improved. And we've got data and research to prove it, but it takes time to change policy. We've done that thing I was showing you with all the different methods of calculating your historic revenue. That's brand new, and that's effort by a lot of folks and friends of mine that went through, and we got that changed for the whole country. And that in itself has now made that much more attractive, because those with volatile revenues can now kind of get closer to their expected revenue, and therefore get better, really pragmatically get better coverage through whole farm revenue than they could before. And I think we've made that better for folks. Now, if they do a couple more things, you could even make it better, but we'll just hold your breath. We'll be working on that.
Jeff, when you say we, are you talking about NCAT, or is it a different group?
No, I'm talking about the National Sustainable Agriculture Coalition. It's a policy change. We met several times over the years with the person with risk management agency that runs this program. And we first tried to convince them to have this policy nationwide. That was in 2014. In 2018, in the new Farm Bill, we got another opportunity, and that's where we changed this thing for the methods of calculating your historic revenue. We changed that. Now, this last year, we tried to get them to drop the necessity of tracking expenses and actually penalizing if you don't. The way it works is if you don't meet 70% of your historic average expenses, you can get dinged for your payout, for your indemnity. And we find that ridiculous, because no other crop insurance policy requires the tracking of expenses. And I understand kind of why they do it, but they should do it for every crop, not just for this whole farm policy. And they don't. For the other ones, you don't have to do that, but for this one, you do. And we can't convince them to drop that. That would end so much paperwork. I mean, 40% of the paperwork would go, and in my opinion, it's unnecessary. And we can't convince them to drop that part of the thing. The other thing that's been happening is they've made it more burdensome for paperwork rather than less burdensome. And this gets into the policy of, again, I think the crop insurance companies not liking this policy, they're afraid that they'll write it wrong, or they aren't calculating the risk correctly. Remember, they get some money if they sell policies that don't lose that much. In other words, they make a profit, they can share in that profit. So they're not incentivized necessarily to sell this product, because they don't know. So what they do is they require even more onerous records often than just tax forms. You can show them your tax forms and they'll say, well, I don't quite buy that, you know, show me your sales records that, you know, that showed that, which we find absolutely ridiculous. They don't do this same kind of scrutiny for any other crop insurance policy, but they do it for this one. And it's bugged the heck out of me, but, so in some ways they've increased that burden rather than reduce it, even though in the 2018 Farm Bill, Congress mandated that they should make this program simpler, and they didn't make it that simpler, despite the intent of Congress to do so. I'm getting into policy now, but it does show you why this has been both frustrating for me and why, you know, it has limited the great potential that this product could provide for farmers across the United States. Boy, that was way more than you guys wanted to hear about, I think. Hello. Did I get cut off?
No, we're still on.
I thought maybe you're cutting me off for getting too long-winded there.
Oh, no. Just answer everybody's question. Everybody's saying it's all good info.
Good.
So that's a great thing. So I know we're going to have to do it again, Jeff. When we had about 30 people that registered, and I think we only have about 12 participants on here.
Yeah,
it's due in part to the weather because we had a lot of people registering earlier.
Yeah, I know, and I'll tell you this, Rocket, it's a reality. Well, there's two things. One, crop insurance, although right now I would think it would be a big draw, but crop insurance is usually not a big draw for folks because it's convoluted and, you know, whatever. That's one issue. But we found with the webinars I've done on this and even other topics, Marianne will always tell you that, like our webinars historically, that if we get 43% of who registered, that's pretty good. If you get over 50% that registered, you're doing well. Because you know how people are, oh yeah, I'm going to do that, and then stuff happens. Well, particularly right now, stuff really happened.
Okay.
You know, people, you know, they have a given intention. But what if their lights went out and they couldn't get on the computer to do it, right? I mean, you have some probably legitimate reasons why people didn't show up. But although on the other end, seeing what's still going on to other crops and things, they probably wanted to find out about crop insurance at this point, because I know it's a terrible, sick joke, but you know, I never liked crop insurance. I never liked insurance. Insurance is one of those things that people don't like to have to go, but they always got to get it. You know, you have to buy mortgage insurance, you got to buy car insurance, you got to buy all this insurance, you got to have health insurance. I know you got to have it. And they're always complicated and they always drive you crazy and you never get what you think you're going to get. So I never really like it. But then again, you know, if you got a house and it burns down, you sure would like insurance, wouldn't you? All those years you pay the premium and you never have your house burned down, you think, well, why did I pay all those premiums?
Right, exactly.
So, but I think nowadays, as we predict we're going to have more of these extreme events, crop insurance has become more and more important, because I think the way we predict premiums and everything is based on history. But if the future is different than the past, it's going to be really hard to calculate premiums and risk. Because, and believe me, smarter folks than me are working that out with crops and insurance. There are insurance companies for insurance companies, if you believe that. And those insurance companies for insurance companies are running all kinds of sophisticated models to try to predict what climate disruption is going to bring for folks in the future, so that the companies that then sell crop insurance are going to go bust, because they're going to know that they're going to have, you know, what I'm saying basically is premiums are going to go up. They have to, because the risk appears to be growing. The volatility of risk across this country is definitely on the rise, and I don't think it's going to go away.
All right.
Well, Jeff, it'll be volatile.
Someone wants to know, will your presentation be available on the website?
Well, that's up to you, Rock. I believe you can put it up there. I think so.
Okay. If not, I could, let me see who asked this.
I think we're supposed to, aren't we, Rock? I mean, it would be really beneficial to have it on the website anyway, so that people can have those to look at. And
yeah, we can see if I can't get it on the website, I can definitely try to email it to you.
Yeah, yeah, and you should do that. Yeah, I mean, you recorded it, so that's great. And I think that my presentation, I don't know, they keep changing the format, but I think it looks good enough to get on the website. But they could also dress it up a little bit if they needed to put it on the website. But as long as the content remained the same and you have the recording. So I think it should be possible. And I would encourage you to, you know, Devonna will be happy because it's more liberal.
Well, if everybody's finished with the polling, I guess, if there are no more questions for Jeff or myself, I guess this will conclude our workshop.
Thank you.
All right.
Everyone have a good day. Thanks a lot. Enjoy.
All right. Thank you.
Stay warm.
Yeah, that's right. Stay warm. I gotta try to find a warm place now. I'm gonna shut my computer because
barbecue in your
my
house.
Lights are out.
Don't do barbecues in your house. That's what I learned. You're not supposed to.
No, I'm not gonna do that.
All right.
All right. Thanks, Jeff. All right. Thanks everyone for coming and joining our workshop.
I enjoy it.
All right.